Stop everything you're doing and listen up, because today I'm going to reveal the timeless tactics of one of the greatest investors of all time. Philip Fisher was a legend who beat the market for decades, and by the end of this video, his proven methods will be yours. Get ready for secrets that can transform your portfolio if you have the discipline to employ them over the long haul. The rewards will be immense if you stick around to grasp Fisher's entire investment philosophy. Now let's dive right in and uncover how this investing wizard consistently crushed his benchmarks year after year. Philip Fisher was one of the most influential investors of the 20th century. He ran the extremely successful Fisher & Amp Company money management firm for decades and authored the investing classic Common Stocks and Uncommon Profits in 1958. Fisher pioneered the idea of investing in innovative companies with strong management teams and buying them for the long term. His approach went beyond just studying the numbers and emphasized really understanding the qualitative aspects of a business. Fisher believed that concentrating your portfolio on a relatively small number of outstanding stocks that you've researched intensely can lead to market-beating returns over time. In this video, we'll explore Fisher's time-tested tactics like favoring growth over dividends, insisting on management quality, and having patience to ride out short-term volatility. Mastering the wisdom of Philip Fisher can profoundly impact how you analyze and select stocks. The number one rule of investing is simple: buy right and sit tight. This timeless wisdom has created legends out of long-term investors like Philip Fisher, who stuck with quality companies decade after decade. In this video, I'm thrilled to walk you through Fisher's proven tactics that have crushed the market consistently for over 30 years. You'll discover Fisher's approach to picking growth stocks for the long haul, insisting on outstanding management, and having the conviction to ride out short-term volatility. Master these techniques that have stood the test of time, and your own portfolio returns could leave benchmarks in the dust. Favor long-term growth over dividends. Philip Fisher's mantra was that picking outstanding growth companies and holding them for the long run would far surpass chasing dividends. He looked for stocks with at least 5 years of annual earnings growth above 10%. In Fisher's view, earnings growth compounded wealth exponentially over long periods of time. On the other hand, high dividend payouts often indicated a company lacked growth opportunities, so he focused on future growth potential rather than past payouts. Let's examine retail giant Walmart's spectacular growth over decades as an example. Walmart paid no dividends for the first 25 years after its IPO, reinvesting all earnings to fuel expansion instead. Yet Walmart stock still grew over 43,000% in that period, crushing the broader market. Walmart's phenomenal growth served as proof of the power of reinvesting earnings. Fisher understood that such compounding growth stocks beat dividend payers over the long term. Insist on proven management. An outstanding management team was critical for Fisher. He would meet company executives personally before investing to assess their leadership. Fisher looked for managers who were energetic about their work and qualified based on their career track record. They needed the ability to inspire employees and make more right decisions than wrong ones. He sought candid managers who admitted mistakes rather than blaming external factors. Fisher studied how managers allocated capital using profits. The best teams intelligently reinvested in areas like research, marketing, and personnel development to drive growth. Fisher also examined executive compensation. Reasonable salaries that rose based on long-term results signaled responsible management. Finally, he believed the best executives had a significant personal stake in their companies through stock ownership. Their interests were aligned with those of shareholders. Stay patient during short-term volatility. Once Fisher bought into a quality growth company, he would ride out short-term price swings and negative surprises patiently. He knew cycles and unforeseen events were inevitable. For example, in 1962, the stock of motor company Cummins Engine took a nosedive when their diesel truck engines had technical troubles. Despite a sharp loss that year, Fisher held on because he believed in their management. By 1964, the problems were resolved, and Cummins grew multifold over the next decade. Fisher's rule of thumb was to give companies 5 years to deliver the growth he envisioned before selling. This conviction separated him from speculators swayed by headlines. Temporary trouble didn't mean a company was doomed. Fisher held on through short-term pain for long-term gain. Conduct scuttlebutt research. Philip Fisher pioneered a research tactic he called the scuttlebutt method. This involved gathering in-depth information on companies not just through financial statements and official filings, but by actually speaking with various people connected to the business: employees, vendors, competitors, distributors, or anyone else familiar with the industry. Fisher found this on-the-ground intelligence gathering to be a goldmine of proprietary insights not available through traditional analyst research. By tapping into the company grapevine, Fisher might uncover if employee morale at a firm was high or low, if a certain new product was flying off shelves, if a recent marketing campaign showed early signs of success, or if supply chain issues were emerging. This scuttlebutt approach allowed Fisher to develop a thorough, 360-degree understanding of a company that went far beyond just the numbers. He valued having an interactive, dynamic view of how each business operated in real time. Just as importantly, Fisher's scuttlebutt method uncovered potential red flags that would never be found in a 10K. For example, discovering high employee turnover or management teams disliked by their business partners would make Fisher cautious about investing. In essence, scuttlebutt research enabled Fisher to separate hype from reality. He leveraged on-the-ground intelligence to supplement official data and gain a true edge. While scuttlebutt took intensive work beyond sitting at a desk crunching numbers, Fisher firmly believed these unique insights were essential to making superior investment decisions. Stick to your best ideas. Fisher was a firm believer in owning a concentrated portfolio of only his highest conviction stocks. He felt that diversification for its own sake was an overrated idea that only distracted from investing in your absolute best ideas. Fisher applied rigorous scuttlebutt research to identify a select group of just 10-20 companies that he understood extremely well and had the utmost confidence in for the long term.
It talks about the scuttlebutt method of investing, which was quite a ways from what Ben Graham taught me in terms of figures, but it's a very, very good book. And
he would take meaningful positions in these stocks rather than spreading his capital too thin. Once Fisher invested in his cherry-picked stocks, he rode them for the long haul rather than flitting from stock to stock. He had no preset time limits on how long to hold and only sold when his original thesis on the company's growth prospects deteriorated. For example, Motorola was a core holding Fisher purchased in 1955 that remained in his fund for over 30 years until he retired in the 1980s. Owning too many stocks was counterproductive in Fisher's view because marginal holdings just ended up dragging down the exceptional returns of your best ideas. When you own 60 stocks, your portfolio return gets anchored to the average. But if you own only your top 10 convictions, your winners have room to really run. Fisher understood that owning fewer stocks increased volatility, but he accepted short-term volatility at the cost of higher long-term returns. He famously said, "If you can identify 6 wonderful businesses, that is all the diversification you need." This exemplified Fisher's belief that a few smart, large bets in companies you know extremely well can build the most wealth, rather than a shotgun spray of average ideas. As he proved, a concentrated portfolio allowed your biggest winners to have a meaningful impact. Philip Fisher's proven tactics, like focusing on growth, assessing management quality, and having long investing horizons, can truly unlock the power of stocks. Treat investing like a business and apply Fisher's principles to set your portfolio up for sustained success. I hope this breakdown gives you clarity on implementing his timeless wisdom. Don't forget to like, share, and subscribe for more content on investing legends. Let me know in the comments which tactic resonated most with you. Stay tuned for our next deep dive.